Hi, this is Professor Karen Lin. Welcome back. In this video, we are going to discuss bad debt expense for the accounts receivable and how to estimate bad debt expenses. Let's first start with the idea of bad debt expenses. Bad debt comes from or results from credit customers who cannot pay the amount they owe regardless of the collection efforts. For example, I sold a book to my customer. My customer promises to pay me while her or his financial aids comes into place, but that person never show up again, and I couldn't find the person. So when that happens, the accounts receivable that are recorded in the first place becomes something called bad debts, because that means my customer defaults. When bad debt happens, we need to record the expenses to reflect the bad debt. Now, my student always asks me, why is it an expense? If you remember, expense recognition principle tells us expenses should match the revenue. So in order to promote sales, to boost my sales, I provide credit sales. Now, an inevitable outcome of the credit sales is that there is always someone who cannot pay us back. So there is always a likelihood a part of the accounts receivable are not collectible. So that becomes an expense to generate the revenue, because it's an inevitable part of our revenue generation process. So companies do keep track of all these different accounts receivables and who owes what in terms of what we call a subsidiary account. A subsidiary account looks like this. So if you look at accounts receivable in the previous chapter, we always talk about accounts receivable. If you in a T accounts perspective, it's accounts receivable, right? For example, I sold a book to a customer and it's accounts receivable, say $100 that I'm going to receive in the future. Now, if I pull all the accounts receivable together, I would not know who owes me what. So we would open an account called a subsidiary account. Let's say this subsidiary account belongs to Karen, okay? Karen bought a book from us. That book costs $100. Now, I will record debit Karen under the accounts receivable account for the $100. In the meantime, I will record this $100 in the master account. So these two accounts, they are parallel to each other. So you don't add them up. So the fact that you have two accounts doesn't mean someone owes you $200. It's the same $100, but the subsidiary account reflects more detailed by your customers. Reflects more details, and it's by customers. All right. So now we come to a problem, because what I've just said, there always someone who can pay us back. Problem is that we never know who wouldn't pay us back, right? And the collection would take place maybe, say, in 3 months. When we recognize revenue on the month when we sell the book. But the expenses has to match the revenue. So which means at the time we recognize our revenue, we do not know how much expenses would be related to that part of the revenue. This leads to this accounting issue of estimation. Because we do not know, we would have to estimate how much we are going to collect or how much we are not going to collect. So the companies would use something called allowances method to measure bad debt expense. And the allowances method is based on estimates of the expected amount of bad debts with 2 steps. So the first step is we will make end of period adjusting entries to record our estimated bad debt expenses. And then if we determine they are not collectible during the next period or some other periods, we will write off those specific accounts when they are not collectible. And when we write off those accounts, it's not reflected in the expenses anymore, because our first step is already recognizing the expenses. Now, don't panic if you don't know what I'm talking about, because I'm going to show you in an example. So let's take a look at this example. Assuming that Skechers made $100,000 credit sale, and also estimated the bad debt expense to be $6,402. Now, all the numbers are in thousands, but I interpret them in dollars because it's just for simplicity. So the company, when during the period recognizing the revenue, would have to recognize the expenses related to the estimated bad debt expense. Now, how do we arrive at the conclusion of 6,402 would be our next question that I will discuss. So let's take it for granted that $6,402 is the amount that's estimated, regardless of the method. Okay, you take my words. So you would have to debit bad debt expense for 6,402. You would credit something called allowances for doubtful accounts. Okay, basically allowances means the money that we set aside. We saw that in the sales discount allowances in the previous video. It's the same idea. So we basically set aside a pool of money or a pool of resources in expectation that in the future someone is going to default on our accounts receivable. So we have this thing called allowances for doubtful accounts. We credit the same amount. Now, what is the nature of this account? Okay, this account is called contra asset account. Now, all the allowances accounts are contra something, okay? If it's allowances for sales return, it's contra sales or contra revenue. If it's allowances for bad debt or doubtful accounts, which means it's accounts receivable, then it's called contra asset, because accounts receivable is an asset account. So this contra asset account would work against your asset account and would be subtracted from the accounts receivable on the balance sheet. So you can see this is how, if you estimate the future uncollectibles, how that would affect your accounting equation is by reducing the assets, in the same time reducing retained earnings, which is under the stockholders' equity. So I wrote down all the information in a piece of paper. This is how your balance sheet is going to report the information that I just talked about. You will see, because the company made $1,000 credit sales. I made this up, by the way. You will see this number on your textbook because I made this number up. So the accounts receivable for this company would be $100,000. The company also recognized the possibility that like 6% or $6,408 won't be collected. So this is something expected, the expected default. Sorry, it's a default. And then accounts receivable subtracting bad debt expenses will be the net accounts receivable. Okay, that's how it works. So intuitively, what this means is that the accounts receivable account reports the original accounts receivable number without considering bad debts, okay? That is the amount, intuitively, the amount the company entitled to collect. And bad debt expense is a contra asset account. It's contra, basically, accounts receivables. So that is the amount that we expect not to be collected, right? This is how much we are entitled. The 6,000 something is what we expected not to be collected. And the rest, $93,598, would be what we expected to collect. So on the balance sheet, if you saw those numbers, you need to understand this is a very detailed or complete information set for the investors, because the investor knows that, okay, we have $100,000 to receive, which could be 100% received. You don't know, because the 6,402 is just an estimate. Your customer could be very nice this period and give you all the money back, right? You don't know. So your investor wants to know the original amount. That's why we don't only report the net amount, we also report the gross amount. And then we also tell our investor that, okay, this is the amount that we don't expect to receive. And then the rest we expect to receive. All right. So now let's assume you do have someone who can pay you back, but it's from the previous period. Okay. So when you have someone not paying you back, and you are sure of it, at that time you would subtract from the allowances account, allowances for doubtful account. Now remember, this account is a contra asset account, which is a negative asset basically, or works the same way as liability. So if you debit a contra asset account, you decrease that account, right? It's just like you debit a liability account, you decrease the liability account. And then we will also decrease the accounts receivable, which means we will be reducing the amount that we are entitled to receive, because that person no longer exists, or no longer, he or she will no longer pay you back. So that amount should be taken out from the original amount that you think you're going to receive. So that is how you write off. Now you can see when you write off, you do not touch the expenses account anymore, because you already recognize expenses when you first set aside the allowances. Now the purpose of the allowances is to set aside a pool of resources, which allows us to accommodate the future bad debts. So when the bad debts really happened, we take that from the allowances. Now my student would say, okay, wait a minute, you only set aside 6,000, but you write off 7,000? How is that possible? That is possible. First of all, this company may have beginning balance of allowances. So if you consider there's a beginning balance of allowances, when that add up with the 6,402, that may be greater than 7,912. Okay. Second of all, even if you take more from your allowances account, which makes your allowances account goes to debit balances, that is also fine, because next period you would adjust your estimate and put more resources in your allowances account, make up for the shortage in your allowances account. So that is possible. All right, the next question. How do we estimate bad debt expenses, right? We talked about the $6,402 in the prior slides. That is an estimate. And I said, okay, take my word, right? Now I'm going to tell you how to estimate the bad debt expense. There are mostly commonly two ways to estimate the bad debt expense. The first way is called a percentage of total credit sales for the period. And the second is called aging of accounts receivable. Both methods are acceptable under the generally accepted accounting principles, or the GAAP, and are widely used. So in this course, we focus on percentage of credit sales method, which is very simple to apply. So its name indicates, percentage of credit sales method would just estimate the bad debt expense by the percentage of our sales. So, for example, if the company determined the bad debt rate or estimate would be 1%, which means the company expects for any $100 sales we made, $1 wouldn't be recovered. So we just multiply this 1% with the total credit sales, which is the accounts receivable. We have the allowances amount, or the bad debt expense amount for this period, $19,700. All right, so how does this 1% come into place, right? How do you know it's 1%? Now, it's usually from history, from the past 3 years, from past 5 years, whatever the company decides to use. So this is how the allowances for doubtful account would look like. Now you can see this doubtful, allowances account has a beginning balance on the credit side because it's a contra asset account. So its normal balances should be on the credit side, just like your liabilities account or the stockholders' equity account. And also, we estimate a newly added allowances 19,700 that will be on the credit side. Remember, you debit the expense, you credit allowances when you first estimate the number, right? So when you debit expenses, credit allowances, it goes to here. So it's the 19,700 from the estimation. Now, suppose during the period there is an estimate of the write-off. Remember, when you write off, you debit allowances, you credit accounts receivable, right? So that means we would debit allowances for the amount that's the write-off, which is the end assumption. So the beginning balance plus the newly generated bad debt allowances subtracting the write-offs, which will equal to the ending balance. Another method, which is a more accurate method, is called aging of accounts receivable. Now this is a little bit more complicated, but based on the assumption that if we look at all the accounts receivable we have at this point, which includes the accounts receivable that's overdue from the past and the newly generated accounts receivable. So if you look at all the accounts receivable, we would divide those accounts receivables into different groups based on how old or what is the age of that accounts receivable. For example, it's not yet due or up to 90 days due, past due, or over 90 days past due. For each group, we assign different percentage, right? This percentage are decided by the company based on their estimates from the history. So for each group of the amount, we multiply by the percentage that we estimate for that group. That gives you different estimates for each group. When you add them up, that is the estimated ending balance of accounts, doubtful accounts. Now, remember, the number we are estimating is not the newly generated. So it's not the credit side of this T account. It is the ending balance of this doubtful accounts. So if you know the beginning balance 24106, you know there is a write-off 14106, and also knowing the ending balance, which we just calculated, right, is 29700. What is the bad debt expense adjustment you need to make? That would just be solving the equation of 24106 plus x minus 14106 equals to 29700. So you solve for the x, which is a question mark here, and get 19700 as the bad debt expense adjustment. So you should focus on the percentage of sales method, which would be shown in the McGraw-Hill Guided Help video 6-2. But if you are interested, which is some of you are more advanced and you want to know more about the aging analysis, watch the video 6-3. Now we mainly focus on, again, the percentage of sales method. But in reality, the aging method used a lot. So if you are an MBA student or if you are working right now, needs the information of aging analysis, you should watch that video. All right? Okay, so I'm going to stop here and I'll see you in the next chapter.